Welcome to the Power of Biz YouTube channel. My name is Tim Delaney, and over the past 11 years, I've purchased businesses and real estate to build my financial independence. My journey began with buying my first business with just 10% down, and through hard work and strategic decisions, I've been able to create the life that I want. I started this channel to share my story and experiences with the hope that I can help you do the same. Whether you're looking to break free from the 9-to-5 grind, build long-term wealth, or take control of your financial future, you're in the right place. Join me as we explore the ins and outs of buying businesses, the challenges and rewards, and the practical steps you can take to create the life you desire. Together, we'll navigate this exciting journey to financial freedom.
How can I afford to buy a business? A question I've heard very often. Today I'm going to jump into ways that you can finance the purchase of a business. It hopefully helps you get over that hump and towards your goals. So when it comes to buying a business, there are actually quite a few options for how to finance the purchase of a business. I'm going to go through a few of them today and then add a couple other options that are out there but are very much less common to help you come up with some ideas into how you can finance a business. One of the most popular ones that is out there is a traditional bank loan. Now, if you're going to go buy a business, ideally that business has shown some level of success and has a decent track record of revenue and expenses, profitability, that you can take those finances to a bank and ask them to lend you the purchase price or a portion of the purchase price for the purchase. So how that works is, let's say you're going to buy the business for $100,000. The bank is typically going to look for some type of down payment from you. They want to see that you have skin in the game, that you are not just going to walk away at the first sign of trouble and go back to your day job and forget that you bought the business. They're also going to want some good collateral, whether it's from the business or you personally, to make sure that you can back up that loan if the business goes downhill. But again, when you're looking to buy that business, you're looking for something that has a decent track record, or if it doesn't have the greatest track record, that you have the knowledge, skills, and ability to really take it to another level and make sure that you can pay off that loan. So traditional banks will lend for the purchase of a business as long as the business is showing some decent track record and you have a good credit background, credit history yourself, and can show some collateral to pay off that loan. The down payments on those are typically going to be 20-25% that they're going to want to see, just to make sure that you are actually invested in the game. Another form of financing that's out there is SBA loans, Small Business Administration. To purchase a business, they have a program called the 7A. To purchase real estate, they have a program called 504. With the 7A loans, these are a little bit deceiving as people talk about SBA loans, using an SBA loan to buy a business. When you're using an SBA loan, you are still actually just borrowing from a bank. It's still kind of a normal traditional commercial loan that you're using to buy a business. However, the bank is getting the backing of the SBA if you default on that loan. So the SBA will step in and cover some of the bank's losses if something goes wrong and you can't afford to pay it. Now, don't think that this gets you off the hook. You're still going to have to pay back the SBA if that's the case, and they will come after you to make sure that you pay it over time. So it's not something to be entered into lightly. But even with a traditional or a commercial loan from a bank, purchasing a smaller business in that under $1 million price point or even a little bit higher, chances are, if it's your first venture, they're going to make you sign personally for that loan anyway. You are going to be liable for that loan. That means if something goes wrong and the business doesn't make it for whatever reason, you are going to have to pay that back personally over time. They're not going to necessarily immediately come and take your house and your car and all of your assets, but they will want to set up a system where you're going to be able to pay them back. Don't get too hung up on these scary scenarios. They can happen, but the reward from buying the right business with the right kind of financing will far outweigh that risk if you do it right. So we have traditional commercial loans from banks where you're going to have to come up with 20-25% down payment, and then they will finance the rest of the purchase, usually with collateral from the existing business, sometimes maybe some personal collateral. On the SBA side, one of the big advantages is they often have much lower down payments. So you can get away with a 10% down payment on an SBA loan versus a 20 to 25%. That makes the barrier to entry a lot easier to get into. There is a lot more paperwork. Having gone through this personally, I can tell you that you're going to get, they're going to go deep. They're going to look at all your bank statements. They're going to look at your history of earnings. They're going to look at the history of the business. They're going to ask a lot of questions. They're going to make you sign and fill out a lot of documents. But that the risk for the bank goes down, so they tend to like that better because they have a backing, and the down payment for you can go down substantially, which makes it easier for you to get into that business. That 10% down payment as well doesn't necessarily always have to come from you or your pocket personally either. They will accept seller financing as that down payment. Our next option for financing a business, seller financing. Essentially what this is the seller of the business is giving you a loan to buy their business. So if their business, they want to sell their business for $100,000 and you don't have $100,000 and you either don't want to go to a bank or can't go to a bank, your credit's maybe not the greatest, you don't have any other collateral, the bank wants some more collateral, that seller can lend you a portion of that $100,000 and you will pay them back over time. They can lend it all to you, they can lend you a small piece. When I purchased my wine and liquor store, I used 10% seller financing. I came in with 10% of the purchase price in cash, and I got a bank loan with SBA 7A backing for that other 80%. So you can use combinations. Could I have tried to push for the bank to allow that seller financing at 10% and then ask the bank for 90%? I could have. I had some cash available, and the bank really wanted me to have skin in the game even with their SBA backing, so it just made sense. That is another aspect of the SBA loans, is that they will ask for a lot of collateral. They want to really see that you have skin in the game. If you own a house, if you own other large assets, they may want you to sign those over as collateral as well, in case anything goes bad. So just something to be aware of. The seller financing, so like I said, you can use it as a piece of the financing, or you can use it for all of the financing. There's really no rules with how that works. It's really up to the seller and how comfortable they are with lending you the money. If they know they have a great business and they're confident in you to run it and continue it the way it's going, and the loan can be structured in a way where you can still get a small salary for doing your job, running the business, and they can get their loan payment over 3, 5, 7, 10 years, sometimes that works out best for everybody because they can defer their capital gains on that sale over the life of the loan instead of paying it all up front day one. In terms of using some seller financing and some bank financing, the banks really love this because it shows that the sellers actually believe in the business. If the sellers absolutely downright refuse to hold any note or to give you any type of financing on the business, it is a small flag that they know something that you don't know, or that the bank doesn't know, that something might be going awry with the business, or they're expecting to lose business, or they know that their value is super high to the business and they don't have confidence that you are going to continue to run it the way that they were doing. So not to say that if they don't do seller financing that it's a bad deal, just it does raise some flags and should make you look a little bit deeper into it. A lot of people just don't do it because they don't understand it. They don't know what it's about, and they feel like it's an unnecessary risk for themselves. The best way to just think about seller financing is if you have an old car and you're going to sell it to your brother for $10,000, but your brother doesn't have $10,000, so instead he offers to give you $1,000 a month for the next 12 months. So at the end of the day, you're getting $12,000 instead of the 10, but it took you 12 months to get that money instead of the day that you sold that car. So we have traditional bank loans, commercial loans. We have traditional bank loans backed by the SBA, the Small Business Administration, which are very similar, more paperwork, lower down payment, a little bit safer for the bank, and a little bit easier to get into for a new business owner. And we have seller financing, so where the seller of the business gives you some or all of the purchase price. Another option for financing is a private lender. What is a private lender? It's really anybody you know outside of a traditional bank that might be willing to lend you the money for the purchase of the business. So this can be a relative, a friend, a business associate, a colleague, whatever. Somebody that has some liquid cash available that they want to make interest money on by lending it to you. Typically, a private lender is going to charge a little bit higher interest rate than a bank, but not always. Maybe you have a really good family member that has a really nice 401k and has all set for retirement and just has some extra cash that they want to lend at what they think of as a relatively safe investment because they really believe in you and or the business and know that you're going to pay them back no matter what. So they can set the interest rate as low or as high as they want, as long as it works for you and the business. One thing to keep in mind with all of these financing options is to make sure whatever your monthly payment is on that debt, that the business can actually afford to pay it. So the business owner might have been running this business for years without any loan payments. So when you're looking at their expenses, their P&L, you want to make sure that when you add in that loan payment, the interest and the principal portion of it, that you're actually still able to make some kind of profit for yourself. Eventually that loan will go away, but you just want to make sure that you can cover yourself in the meantime. So we have commercial loans, SBA loans, seller financing, private lending. There's also partnerships. So instead of somebody just lending you the money, a private lender, you might find somebody that's willing to partner with you. Maybe the loan repayment, the loan interest isn't enough incentive for them, or maybe they're a little bit more willing to take a risk where they give you the money or some of the money in exchange for a piece of the company. So they put up the down payment, you do all the work, and you each own a certain percentage of the company. There's no hard and fast rule of what percentages should be given in those types of situations. That's really up to you and partners to discuss how that would work out. One thing to note though is if you do go that route, the partner that's going to be working in the business should get a salary for that job that they're doing before the profit is calculated and shared, or should be at least discussed thoroughly in that agreement before the deal is made. Also, just self-financing. Do you have a large 401k or retirement account that you can either borrow against, so in a way that you're financing yourself, you're paying back your own 401k with interest, or just liquidate some assets to purchase the business outright. Personally, I'm not as big of a fan as that. I like using leverage to purchase assets. I think your return on investment is usually better, but there might be situations where you just want to liquidate certain cash because of your situation going on right then and there. Those are some of the main ways to finance a business. There are other options out there. Angel investors, which are usually more associated with high growth potential, much riskier type businesses, software industry, technology space. Usually those are not businesses you're going to buy and then exponentially grow. Those are businesses that are already on a path for extreme growth. But angel investors are one. Crowdfunding is another option that has become increasingly popular over the last few years. Again, I associate crowdfunding more with startups where you're trying to launch a product and you can promise somebody a delivery of that product in 6, 12, 18 months or whenever you make it. But you could also tap into that with the purchase of a business. Just make sure you are reading the non-disclosure agreements you signed when you started doing your due diligence on the business to make sure you're not violating anything by making any information public that should not be public. Equipment financing, revenue-based financing are bank loans at a little bit of a higher level business, but those are also available. And then grants. There are government grants out there. There are foundation grants out there to help businesses, but these are not super common. You're going to jump through a lot of hoops and go through a lot of headaches to try to get some of these grants that are out there, and they're usually not going to be designed to necessarily purchase a business. They're money that's available to help improve a business or to help improve a storefront or add a line of business that is going to be good for the local economy or the national economy, wherever the money is coming from, such as export-based businesses. Sometimes there's grants available for those. But those are not necessarily available for purchasing, but it doesn't hurt to look into them either because you never know. So those are just some of the ways that you can finance a business. Like I said earlier, when I purchased my liquor store, I used a combination of seller financing and bank financing with the SBA backing. There is no end to the different types of combinations and ways you can interweave different types of financing and loans and equity partnership into the purchase of a business. I've purchased real estate assets with 90% seller financing, 10% private lending. I've purchased real estate with 100% seller financing, where I've actually gotten a check from the seller at closing because of the way the taxes and credits worked out at closing. So there's really kind of no end to how you can finance a business. The important thing is first to find that really good deal in a company that you feel confident that you can run and hopefully grow so that you can pay the financing and move forward from there. Hope this helps some of you get over that fear or that question of how am I going to buy a business? I don't have any money or I don't have enough money. This will kind of help you set you up to get your mind going, give you some ideas, and hopefully get you on the path towards buying your own business. Please leave a comment below and with an idea that I did not cover or questions on any of that thoughts that I covered. Look forward to hearing from you. Please hit that subscribe button and the like button on this video and share it with some friends. Look forward to seeing you again soon. Cheers.